Good day. This is Sunday, August the 18th, 2024. This is the second installment of This Week in Review, where we look at the markets and in particular the banking market, what's going on with bank stocks, and then we also look at the regulation, what's going on from a regulatory perspective from this last week, Monday through Friday, the last 5 business days. So starting out, I always go with the business cycle to emphasize where we're at in the business cycle. We are in the mid range to the low range, and because of that, we will stocks sectors that will do the best in the mid range would be we're going to experience moderate growth and lower interest rates. Um, Rates have come down a little bit, although when I looked at the yield curve, it did go up a little bit in the shorter end this week, like the 1 to 5 year range. Those yields went up this week. Profits are strong, and that's been the case from quarterly earnings reports from the second quarter that came out here the last month or so. And during this period of time, industrials, IT, materials would be strong sectors to invest in. And it says Fed may raise rates. Well, that's not the case now. So that's why it's a mixture of the mid cycle and late cycle. Late cycle, we have increased inflation, although inflation is coming down. So um, sectors that do well in the late cycle are energy stocks, healthcare, consumer staples, and utilities. And those are kind of defensive stocks that do well in whether the market, what's going on with the economy doesn't matter. With defensive stocks, they do well when the economy is not as strong. And so, because people need to spend money on energy and they need to spend money on food. So, any type of agriculture type of company, energy companies, utilities, um, for example, will do better during this period of time. So, we're still not in a recession yet, and we'll have to see what happens here in the third quarter. But as of right now, it doesn't appear that we're in a recession, and it might very well be an easy landing, as they're predicting. So, when I looked at the sectors, most of them are up. So if you look at the economy as a whole, most sectors are doing well. And when I look at the 52-week range, most of the sectors are at a high. There's a few that are like right of center a little bit, but most are, I'd say the top 25%, top quartile for the price range for the year. And energy has some room still. It's right of center if you look at the halfway point. So it's got some room there. Okay. So those are the different sectors. So most sectors are doing well right now in the economy. And then if in the market. And so if we look at the banking industry, the money center banks have recovered from when there was a scare in the market and everything dropped. So they're recovering, continue to recover. And the banks that I consider to be money center banks are Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Wells Fargo Corporation. So those are the money center banks in America, and all those stocks are, I'd say, in the top 25% of their 1 year high. Okay. Again, the money center banks collectively own about 80% of the deposits in this country or more, 80% or more. If we look at the diversified banks, and that would be money center banks, but also like large insurance companies like AIG. So your large insurance companies, you would also see again the money center banks. So those seem to be doing well. You know what's interesting is that Freddie Mac and Fannie Mae are both cash flowing. Um, Fannie Mae is about 12 billion in free cash flow, and Freddie Mac is around 7, almost 8 billion and free cash flow. So that means that from operations, they generate positive cash flow, which is a good thing. Some of your best companies have the best cash flows. And so like Apple, for example, is one of the bigger companies that has good cash flow. I can't remember who was the top one, but I know Meta, or what was Facebook, is now Meta, is has good cash flow. But sticking to the banking, diversified banks, um, insurance companies, money center banks, some other banks as well, uh, Visa, MasterCard. Most of these most of these companies are doing well. They're after this market scare, they most of these stocks have come back. Now, if we look at just the banking industry, just besides the money center banks, those have come back as well. They're doing well. Besides the money center banks, we could look at like some of the ETFs, like Financial Select Sector for Spider funds. All these bank related stocks are doing well. Whether it's exchange traded fund or mutual fund. For example, the KBW Bank ETF, and then regional banks. So you have large banks and regional banks. So those are all doing good. Got real estate in here too. For some reason they look like they're doing all right this week. Oh, sorry. That thought that was real estate. It was banking. Sorry about that. Okay, so in the banking industry, that's we they had a good week. Let's put it that way. So the week before that, they struggled, but this last week they've all came back nicely. And then as for regulation, the big thing I guess is one is the meeting at Jackson Hole, which is coming up on Thursday and Friday. Pay attention to that. Interesting to see what's going to come out of that. Again, this is where all the big shots come together in banking around the world, and they have a meeting and they talk shop and monetary policy. So we should also hear from the Fed Chairman Powell on Friday, see what he has to say. Maybe he'll make an announcement about rates, what's going to happen in September. So we should have some kind of news on Friday. Pay attention to that. The other thing in the regulatory area is that the Federal Reserve and FDIC have come together on guidance for non-systemically important banks. That's banks over 250 billion in assets that, unlike the money center banks, are not systemically critical. And so they have to have their liquidity plans in by October of next year. So they have basically one more year to go before they have that plan in. And basically they're looking for if the government, if the FDIC has to take over the bank, what's the cheapest way for it to do that? And so each of these banks have to pretty much write out their eulogy, I guess, so to speak, and how they would dismantle the bank in the least expensive way. So, and again, that's only if there's a liquidity crisis, run on banks, that type of thing, something where the FDIC would have to step in and take the bank into conservatorship or receivership. And I believe conservatorship, they do that when they're trying to give it some temporary relief. Receivership is when they're going to sell off the assets or the bank as a whole to a new buyer. And with that in mind, let's remember that the industry since 1989 has been consolidating, the banking industry. That's happening right before our eyes. We'll continue to do so. And so I will be coming up with on a monthly basis, a list of 5 banks that I believe should be targets for takeover by a bigger bank, meaning that they're undervalued. So a bank could step up and offer to buy it cheap, possibly. Okay. Or a bank investor could look at it and say, we want to improve our portfolio. So we'll buy some of these banks, and with the premise that these banks will be takeover targets. So look for that list. It's a premium list. I think I'm going to charge probably $15 for that, $14.99, something like that. So look for that. That's coming up. I'll have these this week in review on a weekly basis. It's mainly for bank investors, bank financial managers, and mutual funds that invest in banks, or fund managers or asset managers that invest in banks. So that's what this website is dedicated to, but and bank investors. But I'll try to make it so that just the average person who wants to find out about the economy, understand that better, that they can follow what I'm saying. All right. So God bless, and I'm signing off for today, Sunday, August 18th, 2024. Until next week, God bless and have a wonderful week.